On today's hot sheet, I'm discussing Morgan Stanley's predictions for 2024, an increase in perks for renters, and the decline in institutional investment, except for this one in a Midwestern market. Today is Tuesday, November 21st, 2023. I am Byron Lazine. I am back, and the hot sheet starts now. Woo! I am glad to be back. I do like vacation. I take the same vacation every single year, the week before Thanksgiving, but it's a pleasure to be back with all of you. I was looking forward to this moment to get back on the hot sheet. Just got back last night and ready to dive in. There's been a lot going on, I see, as I've been out for vacation. But let's dive into what's going on now, as the hot sheet is the only 24-hour look back on the housing market each and every single day that the markets are open, which means Thanksgiving and Friday is a half day for the market. So Thursday and Friday, there won't be any hot sheet, but I'm going to be here for today and for tomorrow to close it out with you. We've got some predictions on what next year is going to look like, because next year is right around the corner. Not sure what you're doing for New Year's Eve, but it is going to be talked about quite a bit here over the next 30 days as we lead up to the end of the year holidays. Morgan Stanley has their predictions of what 2024 will look like when it comes to the housing market. Morgan Stanley says the housing market is poised for an improvement. Of course, we just talked about a week or two ago the line that we are back in a housing recession. Morgan Stanley believes that we are going to have some improvement. Well, what does that look like? Number one, Morgan Stanley believes that in 2024, the economy as a whole will avoid a recession. So Morgan Stanley, check the box. They're in the camp of no recession for 2024. They anticipate a rise in incomes. Okay, so no recession. Number 2 point, a rise in incomes. Number 3, a slight decrease in mortgage rates. Now, despite the resilient economy, no recession, despite lower mortgage rates, they believe that home prices will fall by negative 3% in 2024. What does these four factors mean? Avoid a recession, rise in incomes, a decrease in mortgage rates, and a decrease in home values. Those four factors 100% mean affordability in 2024 per Morgan Stanley heads in the right direction. Those might be four nuggets for a real estate agent to use as they approach people's questions about this 2024 market. I'm still a big believer in getting out there early. Get on the back half. If you don't want to do anything as a buyer or an investor in the holiday season, this next 30, 45-day run that we're coming into now, I'd still be getting in the back end of the winter. The winter offers the lowest prices. So I might be like, you know what, I got to get into this shopping end of December, start making my buying decisions in January, as opposed to when there's going to be the seasonal burst of activity that we see typically every single spring, no matter if the market's up, down, sideways, low transactions, high transactions, right? We experienced one of the lowest levels of transactions ever just this past 12 months. So affordability is going to get better. There's three factors for affordability, and three of them are the four projections that Morgan Stanley has, which is, what do mortgage rates do? What do incomes do? And what do home values do? So every single one of those is moving in the right direction to support affordability, easing up, right? We're in some of the most unaffordable times as calculated right now for home buying. But as we go into 24, those dynamics are going to ease up. But what you don't see from Morgan Stanley here is some significant shift, some cliff that we're just going to drop off, right? We saw my apologies there for the black screen. I definitely got to get a new cord. Bobby, let's go ahead today. I know Bobby's listening on the back end. Let's order a new cord here for the iPad, as well as the new headphones that I forgot in the Connecticut studio. There we go. All right. Morgan Stanley's forecast model expects U.S. home prices to be at the end of 2024 a 0.3% drop. But what you don't see here is a cliff. That valley that you see, that was last year. Okay. That's already taken shape. So their 0.3% being the base case, being that purple line, they actually see us coming back. Their projection to about half of what was lost last year before this end of winter spring market in 23, where prices started to go back up. So their base case is pulling back towards this purple line. I also am a believer in seeing a little bit of seasonal double dip here. I think I think it's going to be more seasonal though than the case for the entire year. BK Schiller believes for 2024, we'll actually see negative 3% drop in prices coming back towards this purple line. The bear case would be below where we dropped to last year as interest rates shot up. Okay. And then the bull case would be a 5% increase in prices. So they don't see any significant cliff. 0.8% is more bearish than where most baseline projections certainly come in. But their baseline projection is also more bearish than where most of the projections are coming in right now. Remember, other predictions, Mortgage Banker Association has U.S. home prices in 2024 at plus 4.1%. I'll actually show you guys my notes here on the back end. If you can read these, let me know in the comments too. We're thinking about maybe sharing hot sheet notes. We share the daily downloads each and every single day, which is the charts like the one I just showed you. You can get them all in one easy place on BAMX. If you're not a BAMX member, use code HOT to get 10% off of that, where you get the downloads each and every single day. BAMX goes up on December 1. Lowest prices ever of all time are going to be now. BAMX is going to go up significantly. If you're in pre-December 1, then you get grandfathered in forever. I saw a little hashtag cancel legacy media company going around this week. So if you're looking for a community, all the daily downloads that we do, all the live streams and courses, certainly consider BAMX. Prices will be lowest forever pre-December 1st for BAMX. But we've got these like extensive notes here that I go through, beautifully done by our BAM team. Thinking about sharing those every day with the BAMX community. Let me know what you think on that. Mortgage Banker Association is plus 4.1%. Fannie Mae plus 2.4%. These are projections for 2024. Okay, Wells Fargo plus 2.5%. Goldman Sachs 0.6%. The AEI Housing Center is plus 4%. CoreLogic's forecast expects 2.6% increase, but that would be from September 23 to September 24. So they're going 12-month running. Now, Zillow's the one that's been interesting. Remember, they were at just a few months ago, we're talking about, hey, they're projecting 2024 to be 6.6% up on 2024. Well, now they believe we're going to be flat. They're at negative 0.1%. That's between October and October of 24. Okay, so negative 0.1%. Don, it looks like Don wants to know too. If we provide these notes to BAMX, you'll be able to grab. We do about 15 to 20 topics per week on the hot sheet. You'll be able to grab the segments you like and plug them into maybe a local market show or local market email list. Moody Analytics expects a 4.4% drop between quarter 4 of this year and quarter 4 of next year. So Moody Analytics is the only one that's not in the positive. Zillow being flat now, all of a sudden swinging off of 6.6 increase. So Zillow's taking these wild swings in real time, though. They're not waiting for it to happen. They're saying, hey, the dynamics that we're seeing right now in the market suggest that we're going to be flat and we're not going to have this 6.6 increase. That's their perspective. Of course, Fannie Mae, Wells Fargo, and Mortgage Banker Association all disagree. They see an increase coming, as well as the bull case for Morgan Stanley, obviously seeing an increase coming. Here are some housing market projections specific to Morgan Stanley that we covered here, that going back to their coverage. The analysts identify three levers to improve. It's those falling mortgage rates, those rising incomes, or falling house prices. We talked about that. They expect the three levers to be pulled to some extent in 2024, leading to significant improvement in housing affordability. When you combine those three, it could be seen for some as significant. That'll also depend on, hey, what's going to happen with taxes? What's going to happen with insurance in 2024? Does some of that get wiped out by those two dynamics? I know buyers are watching that very closely. The report suggests that national home prices will fall modestly in 24 as housing activity picks up, with new home sales outpacing existing sales. Huge number there. They believe new home sales, brand new construction, is going to outpace existing sales. That is a real slowdown and grind on existing, which usually outpaces the latter. Despite the expected fall in prices, the analysis analysts believe strong fundamentals of existing homeowners will prevent sizable corrections, will prevent those huge drops. Okay, so there you go on the Morgan Stanley projections. Again, you can get those downloads. We haven't done the notes just yet, but you can get the downloads like this one here, where they forecast the average 30-year fixed mortgage rate in BAMX in our daily download section. Just use code HOT to get the lowest price of all time. Get in before December 1st, so you're grandfathered in on your current price on BAMX. So here's a forecast for average 30-year rates with Fannie Mae, Mortgage Banker Association, and Goldman Sachs, all looking at a 6 handle by about mid next year, except for Goldman Sachs, 7.1 in quarter 3. Quarter 4 of next year, 2024, everybody with a 6 handle. 30-year fix has been pretty kind here last week. I should take more vacations maybe, because I'm looking and I'm like, wow, this has been relatively stable. It's been relatively, a good number based off where we were just a few weeks ago, being under 7.5. We'll go to the 30-year fixed right now, just because I'm excited about this. I'm excited about what I've seen here as a trend line being below 7.5, 736, 737, 738, the last 3 reads. That's great news that we're getting some stability there, and it's sub 7.5. It's definitely good for buyers as well. But there's more good news for renters. So if you're thinking about, if you've got a client who's thinking about between renting and buying, renters continue to get more good news for them. Okay, so according to Zillow, increased concessions are happening in rental listings. Zillow reports a rise from 24% last year on concessions to 30% now, where the property management company, the landlord, the property owner, is offering some type of a concession in the listing, such as free month's rent or free parking, which is indicating a trend that there are better deals for tenants right now. Certainly, it costs you about half of what it costs to rent versus going out there and buying, so that you're going to continue to see low sales as long as that's the case. That's that unaffordability that unfortunately we're dealing with in the market. We need that to swing significantly. It's not going to swing anytime soon. Okay. What we're going to see here in the end of this year and really the beginning of next year is all of these apartments coming online. As all those apartments come online, the new construction, which is going to stop. You're not going to see as much building as you've seen here, but these units are now coming online. There's going to be a boom in inventory. You're going to have a lot of this concession, battles going back and forth. Think gas station battles where everybody's dropping a penny on the gas prices. You're going to see that with apartment complexes. Okay. It's not going to be dramatic drops, but you're going to see a flattening in rent prices. Don't get it twisted here. This isn't a cliff. This isn't a fall in rent prices, but a flattening in rent prices. Typically, rent prices go up every single year. You may not see rent prices go up for a couple of years. Even Grant Cardone, who's one of the biggest proponents of apartment buildings and apartment investing, of course, who rightly talks about how rent prices have gone up every single decade since he's been alive. You can set your watch to it. That absolutely is true. But also, I believe his projection for the next couple of years is in alignment with all of his inventory that is coming on, which is you're going to see a flattening in rent prices over the next couple of years because of this construction boom. The construction boom impact per Zillow is experienced as share in multifamily property construction. You're talking about Phoenix. You're talking about Atlanta. I've seen the highest increase in rental concessions as these apartments have come online in those two markets. If you're in Phoenix, if you're in Atlanta, are you seeing that? Are you seeing concessions rise on some of these rental properties? Zillow is seeing them. They have quite a bit of data, but I'd love to know what you're seeing, boots on the ground, suggesting a correlation between construction activity and landlord flexibility in offering perks. If you've got maybe a 3 or 4, like a 4 unit, which is going to become desirable now. Are we past November 18th? Yeah, we're at November 21st, right? So there's that new FHA. You only have to put 5% down to get a 4-unit building. So they may become desirable on the purchase. But if you're a renter perspective living in one of these 4 units that doesn't have amenities, doesn't have pickleball, doesn't have a pool, isn't brand new, maybe the landlord hasn't really paid much attention to it. Those, everybody's going to rush to go buy those. The price is going to get shot up because people are putting 5% down now with this new FHA, this government-backed loan that's now available on 4 units. And they might be running in to compete against these brand new apartment buildings. Places like Atlanta and Phoenix, I don't know, owning the onesie twosie you might really, the only way to compete might be to cut price off of the median price point. Okay, some of these beautiful construction properties. So this is advice that I'd be giving to an investor if I'm speaking with an investor. This would be what I'd be thinking about if I am investing in those markets. Okay, is my 2-unit, my 3-unit, my 4-unit going to be able to compete with the brand new construction as they're offering incentives like parking or free months rent, and they already have beautiful amenities built in. Dawn is seeing it in her part east of Dallas, her part of the country, which is east of Dallas. Continued residential construction. Residential construction has remained robust. This is for apartments. 408,000 multifamily units added in October. The report suggests that multifamily supply influx has continued into 2024. Okay. Record high multifamily completions. Okay. We haven't seen this many completions, which has happened in the first and second quarter of 2023 since the 1980s. Multifamily units under construction in October only marginally down from July's record high, indicating sustained construction activity and sustained completions. I think as some of these come online, you are going to see with where rates are a slowdown in new projects. But these projects that started 3-4 years ago, they're going to get completed. They're going to get wrapped up. They're going to come on to the market, and they're going to have to get filled up very quickly, right? There's just no question they're going to have to get these properties filled up very quickly, especially with vacancies increasing in other parts of the country. Here are the 10 metro areas, according to Zillow, with the largest share of rental concessions: Salt Lake City, Utah; San Jose; Washington, D.C., Charlotte; Minneapolis; Dallas; Phoenix; Austin; Nashville; and Atlanta have the largest share of rental concessions right now across the country. If you're in one of those markets, let me know what you're seeing in those particular markets. Okay. We've also seen, as we see perks for renters coming in, and we see rent prices flattening, which I've been talking about for a long time. Hopefully Jerome Powell is paying attention to that. Nobody's doing it work. Well, I'm not, again, where I stand on Jerome Powell. I don't want to beat up on Jerome Powell. I think he's got a tough job. But right now, nobody's making it harder than Jay Powell on housing affordability and getting people into more rents as opposed to an ownership opportunity and pushing people out of, jobs, obviously. But, and institutional home buyers have also taken the hit. Okay, they're not going to be buying in these high interest rates, and we've witnessed a significant decline in institutional home buying activity. There is one Midwestern housing market that is bucking that trend, though. Okay, so national decline in institutional home buying, according to John Burden's research and consulting. Institutional operators owning at least 1,000 homes. So these are significant institutional single-family home buyers. Okay, we're talking single-family home buyers. That was 2.4% of purchases in quarter two of 2022, which dropped to 0.4% in quarter two of 2023. Remember, these guys don't own more than 1% of homes. So even when you hear 2.2% in home purchase in quarter two of 2022, doesn't mean they own that. When you took it all investment single family homes, it's less than 3%. When we're talking about Airbnb, institutionals, less than 3%. iBuyers, flippers, you put that all into a bag, it's less than 3% of the homes across America. But institutional buyers alone bought 2.4% in quarter two of 2022 when interest rates were much, much, much lower. 0.4% just this past quarter two in 2023. There was one exception to this rule, though. That market would be Columbus, Ohio. Okay. So Columbus, Ohio actually saw a share of institutional acquisitions over the last 3 months alone at 10.4%. Cleveland, Ohio saw it at 3.8%. Phoenix, still pretty high at 3%. If you want to grab this chart, by the way, just grab it in BAMX. You can use code HOT to get into BAMX, get 10% off doing that way. 10 regional housing markets where institutional investors bought the most single-family homes over the last 3 months. These are institutional investors with at least 500 plus homes on this list. The top 10 outside of Columbus, Cleveland, and Phoenix include Memphis, Atlanta, Charlotte, Nashville, Jacksonville, Cincinnati, and Orlando. Orlando, the share of institutional acquisitions was 1.5%. So you can see the wide gap there in the top 10%, being 10.4% for Columbus, at number one, all the way to 1.5% in Orlando. Columbus, Ohio has been the epicenter of institutional activity during a period where acquisitions have typically come to a crawl. This is Jason Lewis, the co-founder of Parcel Labs. Acquisitions are heavily concentrated in Ohio and Cleveland, 14.2% of all acquisitions to be precise. What's notable about the Ohio markets is these operators are paying more for homes than the rest of the market. This could be due to different buy box criteria than what's pulling through in those markets, where these markets are starting to get hot for similar units, as many of those operators have similar buy box criteria. Okay, so there you go. Some analysis on where institutional buyers are buying right now, albeit a much slower pace than they have historically, or they have in the last couple of years. Not historically. I apologize there, but in the last couple of years. I won't apologize for this. This is good news. Seeing the 10-year continuing to drop just a little bit. Love to get it back under that 4.4 line. That was a huge line when we broke it this past, 30 to 60 days, when we broke 4.4 and 4.5 on the 10-year, first time since 2007. To get back below 4.4, which we're very close to doing right now, would be a huge win and would help continue to push the 30-year fixed rate down, which, if you're just joining us, is down to 7.38 off of yesterday's read. Last week, 30-year fixed weekly survey was down to 7.44. So again, maybe I need to take more vacations. We're heading in the right direction there. Stock market today, not heading in the right direction. You get the Dow, S&P, and NASDAQ all down to start the day, but those are just down very slightly. So as we come into this holiday weekend and Black Friday and all of that, we'll continue to see what happens. I'll be back with you tomorrow on the hot sheet as we close out the hot sheet. So I think let's get the phone number going for tomorrow. Let's do a little bit of a free format Wednesday before Thanksgiving Day edition of the hot sheet. Of course, I'll be talking about all of the most important trending stories. I also have a video for tomorrow that I'd like to react to with all of you. I think it's pretty insightful. So we got a lot tomorrow on the hot sheet. I'm glad to be back. Hope everybody is planning on having a great holiday week, and I'll see you back here on tomorrow's hot sheet. Until then, toodaloo.